Financial scandals do not erupt merely because rules are broken. They erupt because belief is betrayed. When I look back at the scandals that truly rocked the world, I do not see isolated acts of fraud or a few bad actors slipping through cracks. I see moments when entire systems revealed the gap between how they claimed to function and how they actually did. Scandals matter in history, not because money was lost. Money is always lost, but because trust collapsed. And once trust collapses, markets, institutions, and even nations are forced to confront uncomfortable truths about power, incentives, and human behavior. One of the earliest and most instructive scandals was the South Sea Bubble of 1720, not simply a speculative mania, but a scandal rooted in political collusion. The South Sea Company promised vast profits from trade with Spanish South America, profits that were largely imaginary. What made this scandal seismic was that it was sanctioned by the British state. Members of Parliament accepted shares. Debt was swapped for equity. The public was encouraged to believe that national prosperity and private enrichment were aligned. When the bubble burst, fortunes evaporated, but more importantly, faith in government-backed finance was shaken. The scandal exposed a timeless danger. When political authority blesses financial fantasy, skepticism becomes socially disloyal and disastrously expensive. The 19th century brought scandals tied to industrial scale. Railway manias were not only bubbles of optimism, but breeding grounds for accounting deception and insider manipulation. Promoters inflated costs, siphoned capital, and disguised losses, while railways themselves transformed economies. Investors were left to discover that technological progress and financial honesty were not the same thing. These scandals taught a hard lesson that would echo repeatedly: innovation creates cover for abuse. When society is intoxicated by progress, oversight weakens precisely when it is needed most. Perhaps no scandal better illustrates the moral ambiguity of finance than the collapse of the City of Glasgow Bank in 1878. Its directors falsified balance sheets for years, hiding losses while paying dividends to preserve confidence. Shareholders, many of them middle-class professionals, were personally liable for the bank's debts. When the truth emerged, thousands were ruined, not because they were reckless, but because they trusted audited accounts and social reputation. This scandal reshaped banking law and corporate liability, reminding the world that transparency is not a virtue markets naturally produce. It is a discipline imposed after catastrophe. The 20th century globalized financial scandal, along with finance itself. The 1920s were filled with insider trading, stock manipulation, and misleading disclosures long before regulation existed to restrain them. The crash of 1929 was not caused by scandal alone, but scandals multiplied its impact. Public outrage was fueled not only by loss, but by the revelation that insiders had exited early while ordinary investors were encouraged to buy. The subsequent Pecora hearings in the United States exposed conflicts of interest so brazen they permanently altered the relationship between finance and the state. Securities laws, disclosure requirements, and regulatory agencies were born not from theory, but from humiliation. Fast forward to the late 20th century, and the scale of scandal grew alongside corporate complexity. The collapse of Enron in 2001 stands as one of the most consequential corporate scandals in history. Enron didn't fail because its executives stole money directly, but because they engineered reality itself. Through special purpose, entities, and aggressive accounting losses were hidden profits manufactured and risk displaced into shadows. Analysts applauded, auditors signed off, regulators hesitated. When Enron imploded, it revealed a systemic failure of gatekeepers who were paid to question but incentivized to comply. The scandal destroyed not only a company, but confidence in corporate reporting across the global economy. WorldCom followed quickly, demonstrating that Enron was not an anomaly, but a symptom. By capitalizing expenses as investments, WorldCom inflated earnings by billions. The deception was simple, almost crude, yet it persisted because growth narratives discouraged scrutiny. Investors wanted scale, executives wanted stock prices, auditors wanted fees. The fraud succeeded because it aligned incentives across the system. History notes this pattern relentlessly. The most dangerous scandals are not clever, they are convenient. The early 21st century then delivered a scandal that transcended corporations and engulfed the global financial system itself. The 2008 financial crisis was not one scandal, but a mosaic of them: misrated securities, predatory lending, hidden leverage, and moral hazard elevated to policy. Mortgage-backed securities were sold as safe, despite being built on fragile assumptions. Rating agencies stamped approval. Banks transferred risk they didn't understand. Regulators trusted models. When the system collapsed, the scandal was not merely financial loss, but asymmetry. Institutions were rescued. Households were not. Trust, once again, was the true casualty. Europe had its own scandals, quieter, but equally corrosive. The LIBOR manipulation scandal revealed that some of the world's largest banks had colluded to rig benchmark interest rates, affecting trillions in contracts. This was not a rogue trade. It was routine behavior normalized within institutions. Traders joked about it in messages. Management looked away. Regulators assumed integrity. The revelation that a foundational price of money itself had been manipulated struck at the core of financial legitimacy. If the price of trust could be adjusted casually, what else was illusion? Emerging markets were not immune. The Asian financial crisis exposed crony capitalism, opaque banking, and politically connected lending. The scandal was not illegality per se, but favoritism disguised as development. When capital fled, weaknesses were revealed brutally. More recently, scandals like 1MDB in Malaysia demonstrated how sovereign finance could be weaponized for personal enrichment on a global scale, using international banks, shell companies, and legal complexity to launder legitimacy. These were not failures of one country, but of a global system willing to suspend disbelief for profit. Across all these episodes, a pattern emerges with unsettling clarity. Financial scandals thrive where complexity outpaces accountability, where incentives reward short-term appearance over long-term truth, and where authority discourages questioning. They are rarely exposed by those in power. They are exposed by collapse whistleblowers or political necessity. And once exposed, they always provoke the same ritual outrage: reform forgetting. What fascinates me most is how quickly scandal fades from memory once markets recover. Institutions change names. Rules are rewritten. New technologies promise safety. Each generation believes it has learned enough to avoid repetition. And yet history shows that the conditions that produce scandal, human ambition, asymmetrical information, and concentrated power are structural, not episodic. Scandals are not deviations from capitalism. They are stress tests, revealing where its guardrails are weakest. To study famous financial scandals, then, is not to indulge in moral judgment, but to map recurring fault lines. These stories teach us where incentives break alignment, where oversight becomes ornamental, and where trust is stretched beyond durability. They remind us that finance is not neutral infrastructure, but a social system shaped by memory and amnesia alike. And it is precisely at the moment when confidence feels most justified, when regulation feels most obsolete, and when profits feel most deserved, that the seeds of the next scandal are quietly being planted beneath the surface of respectability, waiting for the moment when exposure is no longer avoidable, and the cycle turns again into taking shape beneath the surface. Because history shows that scandals are not sudden explosions, but slow accumulations of tolerated behavior. Long before exposure, warning signs are visible to those willing to look small, rule-bending excused, as pragmatism conflicts of interest, dismissed as unavoidable complexity, praised as sophistication. Each step feels rational in isolation. Together, they construct a structure so fragile that it can only survive as long as no one insists on seeing it clearly. In the aftermath of every great scandal, societies respond with reform, but reform is never purely technical. New regulations are written, oversight, bodies empowered, disclosures expanded. Yet the deeper change is psychological. For a time, skepticism returns. Questions are asked. Gatekeepers rediscover caution. This period rarely lasts. As memories fade and new prophets emerge, the same pressures reassert themselves. Regulation becomes box ticking. Compliance becomes performance. The lesson history offers here is uncomfortable rules alone do not prevent scandal. They merely change its shape. What truly distinguishes scandals that rock the world from those that fade quietly is scale and symbolism. Enron mattered not just because it collapsed, but because it embodied the ideal of modern innovative capitalism. LIBOR mattered because it touched the foundational price of money itself. The 2008 crisis mattered because it revealed that risk had not been eliminated, only hidden and redistributed downward. These scandals force societies to confront not just broken rules, but broken narratives. They shatter the stories people tell themselves about fairness, competence, and control. Another pattern repeats relentlessly. Accountability is asymmetric. Individuals at the center of scandals often escape with reputations bruised, but lives intact, while the costs are socialized across workers, investors, and taxpayers. This asymmetry deepens cynicism and weakens trust more than the original loss. History shows that when consequences are perceived as unfair, reform loses legitimacy. People do not demand perfection, they demand proportional responsibility. Without it, every future promise rings hollow. Scandals also reveal how globalized finance has become. Money moves faster than law. Jurisdictions compete for business. Complexity obscures responsibility. A fraud conceived in one country can be executed through another and paid for by citizens halfway across the world. This diffusion of blame makes modern scandals harder to resolve conclusively. They end not with closure, but with exhaustion. The system moves on carrying unresolved resentment beneath renewed optimism. Yet there is a final, often overlooked lesson embedded in these stories. Financial scandals, destructive as they are, have repeatedly forced progress. Modern securities regulation, auditing standards, banking supervision, and consumer protections were all born from scandal, not foresight. Each exposure narrowed the space in which abuse could hide, even as it pushed it elsewhere. This does not excuse the damage, but it explains why scandal and reform are locked in a grim partnership. Capitalism evolves not by avoiding failure, but by surviving it. To understand famous financial scandals, then, is to understand the cycle of trust and betrayal that underpins modern economies. Confidence fuels growth. Growth invites excess. Excess invites concealment. Concealment ends in exposure. Exposure resets trust temporarily. This rhythm is not a flaw to be patched. It is a structural feature of systems built on delegated authority and imperfect oversight. For investors, citizens, and policymakers, the enduring lesson is vigilance without illusion. Scandals are not aberrations caused by uniquely immoral individuals. They are warnings about incentive structures that have drifted too far from accountability. The question is never whether another scandal will occur, but where the next tolerance for unreality is forming right now. If this journey through the world's most famous financial scandals has changed how you interpret headlines and balance sheets, I invite you to subscribe and continue these historical explorations with me, and to leave a comment sharing which scandal you believe best captures the dangers of modern finance, because history does not protect us from repetition, but it does offer the rare advantage of recognizing the pattern before the collapse forces everyone else to see it.